Hello, everybody. Back live. Happy New Year, everybody. So glad you are here with us. I am so glad to be back down on the floor. It has been a while. So happy New Year, happy 2025. Market's off to a good start, a little bit different than kind of where we ended last year. Friday was a big day. S&P's currently up 57 points today, but still on really anemic volume. We're seeing 848,000 contracts have traded so far. Uh, very, very anemic volume. Came out of the gate pretty hot this morning and pretty much just been here all day. And, volatility hasn't moved. We typically see the VIX, you know, heading south when we see a big market rally. VIX is really unchanged today. I'm looking up here. Spot VIX is down literally 7 cents. And if we take a look at VIX futures here, let's take a look. Okay, we can see that pretty much unchanged on the futures curve throughout. So, definitely something to be aware of. And for those of you in my OV room, that's one of the reasons that we actually bought some downside in the Qs today. Just really cheap. Vol's gotten hit in the Qs, even though the VIX is not getting hit at all. And so it's looking, opportunistic, much like we did about a month ago, 3 weeks ago. We had bought pretty much those same strikes in the Qs, the 510, 500 put spread, really, really cheap. And, we made over 100% on that. So we're kind of at that juncture again. So this is what I want to talk about today, everyone. And this was something that we were talking about last week a lot, especially in the OE room where we had a Netflix position, exercise and assignment. And it is so imperative, so important that everybody understands what exercise and assignment is. Mike, can you see this on the screen? Yeah. How about a chat? Where do I get chat? Hang on, everybody. We're trying this new stream here. Oh, there we go. Wonderful, wonderful, wonderful. So Mike just posted up here in the chat, guys. There is a link. You'll see this bit.ly, BITLY. There's a link to this presentation today. It's actually a link to a video that I produced. So that'll take you right online. That really sums up everything that's in this presentation. So exercise and assignment. Let's talk about what it is, what happens during exercise and assignment, and why it is so imperative that you understand what it is. So, little tongue in cheek here, got the exercise on the left part of your screen, and then you have an assignment there on the right. But this is really, really important option trading basics to understand exercise and assignment. So, what is it? So, first thing we have to realize, okay, option buyers, when you own an option, you're long an option, you have rights. If you sell an option, if you're short an option, you have no rights. You have obligations. Okay? You have to understand that. So let's say you trade a call spread. You buy one, sell one. The option that you own, you control that. Okay. The option that you sold, the one that you're short, the other person in the world that bought that from you, they control that option. Now, that doesn't mean you can't close out your position. You can always close out your position and just be flat, have nothing there. But if you let the position go to expiration, or in some instances, even before expiration, an option can actually turn into stock. Okay. So let's go through some basics here first. Okay. The basics of what does an option do? An option gives the owner the right, like I just said, the right, not the obligation, to buy or sell a stock at a certain price up until a certain time in the future. Okay. An assignment forces the short option seller to take action. Okay. So if I am short an option, the other person in the world chooses their right to turn that option call or put into a stock position, okay, I have got to adhere to those rules. What are those rules? If I have a short call that gets assigned to me, okay, that means that I must sell that stock at the strike price. If I have been assigned on a short put, that means I must buy the stock at that strike price. Okay. We have, again, no control over that assignment. That is the other person in the world that owns that options. Now, on the flip side of that, for the options that we own for the long option positions, okay, we have the right to control that option. We can let it ride all the way to expiration. We can choose to exercise our right to turn that option into stock, whether it's a call option into a long stock position or a put option into a short stock position. Okay. So, very, very important to understand rights and obligations. Joselito, yes, yes, assignment can happen before expiration. It's not very common, but it can happen before expiration. Now, we need to understand the two different types of options out there. 90, probably 98%, maybe even 99% of everything we trade are going to be known as American style options. American style options are what we trade on, stock options, on ETFs, okay, like Qs, SPY, okay. Those options can be exercised early. Typically, this scenario that they would be, if in fact they would be exercised early, would be because there may be a pending dividend. And we're going to talk about that in a little bit. Okay. Index options, VIX, SPX, NDX. Okay. There are no early exercise of those types of options. So those are known as European style options. Okay. So if you're trading in a commodity, you're trading in some asset class, one of these indices, okay, that is a European style option, there's no early exercise risk. Okay. Is that clear? Joselito and everybody else, is that clear? Okay. So I'm not going to go real detailed into, hey, John, how you doing, man? I'm not going to go real detailed into Black-Scholes and the option pricing model. Okay. But Black-Scholes is actually based on European style options. Okay. If we were to compare two identical options, okay, same strike price, same time to expiration, implied volatility being the same, absolutely everything being the same, except for one being an American style option and one being a European style option, the European one would actually be priced cheaper. It would be priced less expensively. And why is that? Well, because we know exactly when that expiration is going to be. And there is some small percentage, an outlier percentage, but nonetheless some small percentage that on an American style option, it could be exercised early. Okay. So what happens to every option at expiration? Okay. What happens to the delta? That's for you. Question for everybody. What happens to the delta of every option at expiration? Hey, Thomas, how you doing, man? Okay. That's one answer. Zero is one answer. What's the other answer? Goes to zero if that option is out of the money, if that option is worthless. There you go, Bobby. Thank you, Bobby. Jay, Stephen, there we go. Clive. Okay, if it's in the money, an option will turn into a stock position at expiration. Therefore, it's 100 delta because a stock position is 100 delta. So every option at expiration is 0 or 100 deltas. Now, what about the extrinsic and intrinsic value at expiration, or the time value, the theta decay? What happens to that, to every option at expiration? Yeah, my water bottle is tripping here. What is going on? It's no good on the floor here. What happens to every option, the extrinsic and intrinsic value at expiration? Right. There is no extrinsic value left. So either an option is worthless, again, if it's out of the money, or if it's in the money, okay, it's worth what's known as its intrinsic value. Okay. Now there is some risk at expiration. What happens if a stock closes right at a strike price? Okay. So what's that? Oh, it is. Uh-oh. There we go. Is that better now, everybody? No? How do you know, Mike? Oh, okay. Not sure what is going on here, everybody. Wait, now we're good. Okay. Sorry, I think some of my water dripped on here. All right, sorry, everybody. So what happens if a stock closes literally right at a strike price? Well, we don't know then, in that case, if that option is going to be exercised and turn into stock, right? It's really a 50-50 chance. That is what's known as pin risk. If we are pinned right at a strike price, okay? And there definitely could be some risk to your position if you are pinned. When that happens in that scenario, we would always trade out of our position. We'll talk more about that later. Okay. Now, what actually happens behind the scenes at expiration to your options? Okay. What does your brokerage firm, your clearing firm do with those options at expiration? Okay. Let's say, it's Friday afternoon and 3 o'clock closing bell rings, and you've got these options that are either in the money or out of the money, and they're on your trading sheets. What does your brokerage firm do? Well, if an option is a penny or more in the money, your brokerage firm is automatically going to exercise that option. So if it's a call option that's penny in the money, you're going to get long stock at that strike price. It's a put option, penny in the money or more, you're going to get a short stock position. Okay, so that happens automatically. But let's say there's a scenario where maybe a stock closes right at the strike that you have. Let's say you own some calls, but you don't want to exercise those calls. Let's say the call option expires 2 cents in the money, but you're really not so bullish on the stock. In fact, you think maybe there's a chance that the stock is going to go down. So even though that call option is in the money and your brokerage firm would automatically exercise that option and turn it into stock, you have the right to fill out what is known as an exception notice or a contrary exercise. This is part of your rights. This is part of that rights and obligations. As an option owner, you have that right. You can instruct your clearing firm, your brokerage firm, not to exercise that option. Okay. You have to do that before 4:30 Central Time on a Friday. Okay. Also, on the flip side to that, let's say you have an option that is out of the money. Let's say you have some call options that expire 5 cents out of the money, 8 cents out of the money, whatever it is. Okay. So they're worthless, right? And they wouldn't be exercised. But you want to have the stock position because you think the stock is going to open higher the next day or Monday, whatever it is. Likewise, because you own that option, you have the right to notify your brokerage firm, again, with one of these exception notices or contrary exercise. You have the right to let them know that you do want to exercise that option. Okay. That is what's known as an exception notice or a contrary exercise. Okay, so let's talk about again how this process works, because so many times I get asked the question, how does the clearing firm know when when to exercise, or how am I going to get how is it going to affect my position, or if I'm short an option, how do I know if I'm going to get assigned or not? Jeremy, if it's out of the money and you don't want the stock, if it's out of the money, Jeremy, it's just going to expire worthless. It is not going to be exercised. You don't have anything to worry about in that case. Okay. You don't have to fill out anything. Okay. So you are good to go. You are good to go. Okay. So here's what happens behind the scenes at your brokerage firms. Okay. If, let's say, I own whatever it is, call or put option. Okay. I submit my exercise, and this would be early exercise. And we're going to go into it how and why you would have early exercise. I would submit a form. Okay. If it's not at expiration, to the broker, to my brokerage house, who then sends that over to this, let's call it company. It's another entity called the OCC, Options Clearing Corporation. Options Clearing Corp is who every transaction, regardless of what platform it's traded on, regardless of what exchange it's traded on, every trade gets matched up at the OCC, Options Clearing Corp. Okay. So if there's an exercise notice, again, not at expiration, but early, if there's an exercise notice, OCC is going to randomly select a broker. Okay. Basically, it's like the wheel that we're going to go to in a little bit. It's like our wheel. It's called an assignment wheel. Okay. So it is a random generation of who may be assigned. Okay. A lot of retail traders, especially if you haven't been in this for a long time, think that the game is fixed, it's rigged, whatever it is. It's not. It is a random generation. Assignment is random. Now, speaking of wheel, let's just kick it off, guys. 2025. That's our word or number of the day here. Okay, let's get those 2025s in the chat so we can get everybody on the wheel today. Gene, number one in the house there. Way to get on the keyboard quickly.
59 quarter put ones. Jan 10, 58 half put ones.
All right, we'll give this another 30 seconds or so, and then we'll go back to our assignment and exercise. All right. So, what happens at expiration if we have an in the money position, specifically an in the money spread? Okay, much like what we had in Netflix on Friday. Okay, this is super, super important here, everybody. So, again, number one, if an option, if an option expires in the money by a penny or more, it is automatically going to be exercised unless we choose not to do that. So spreads that expire in the money, if both legs are in the money as well, both options will exercise. So the short option that everybody is always concerned about, because they don't want to be assigned. They don't want to have a stock position. The short option will be offset by your long option. Okay, we always talk about that. Okay, does everybody understand that? As long as each option is a penny or more in the money, they will offset one another. So your short leg is going to be assigned, your long leg will automatically be exercised. Does everybody understand that? Okay, now that doesn't have anything to do with your P&L. What it has to do is what your stock position may be after expiration. So if you have sold a spread, whether put spread or call spread, if you have sold a spread for a credit, okay, but both options expire in the money, that spread is going to be at its max value, which would be the width of the strikes, and your loss would be the width of the strikes less any credit that you received. Okay. If you have a long spread, whether it's a long call spread, long put spread, a debit spread, same thing, both options are in the money, it'll be the reverse of that. Okay. The spread will still be at its max value, and your P&L would be the max value, which is the difference between the two strikes, less what you paid. Okay, Gustavo, that's good. If you have any questions, let me know, man. Okay, let me know. The key is, everybody, and man, we talk about this repeatedly in the rooms, especially if we are ever in a position close to expiration where we might be in a position where there could be exercise and assignment. We always talk about how one will offset the other as long as they are both in the money. Okay, so here is kind of I put this together, a flow chart, if you will, of actually what happens during an exercise and assignment process, where it goes from the long call, okay, goes to your broker, whether it's Schwab, TD Ameritrade, whoever it is, okay, goes to OCC, Options Clearing Corp, and then it goes in that wheel. Literally, it like generates a random wheel as to who gets assigned. And then the same thing happens there with a short option as well. Now, talked about when can an option be exercised early? Any American style option can be exercised anytime. Typically doesn't happen. The time that it would happen, okay, is if potentially there is a dividend, and then there still has to be a certain calculation. We're going to go through that right now, because there's a couple that I noticed coming up, a couple stocks that have dividends coming up in the next few days, where call options, owners of those call options might exercise their options early in order to collect the dividend. So one of the big misnomers out there is if you own a call option, that does not give you the right to collect that dividend just by owning a call option. Okay, you actually have to exercise that call option, turn it into stock to collect the dividend. Okay, so the way that it is typically kind of calculated as to whether a call option would be exercised early, okay, is if you exercise your call. So in this case, we're looking at General Mills. Okay, General Mills pays a 60-cent dividend on Friday, this Friday morning. Not end of the day at expiration, but Friday morning. Anybody that is going to collect that dividend has to have that stock by Thursday night. Okay, right now, the stock is 62.5, 62.60 or so. Okay. If we look at the call options down here and look at the markets here, how do we know if we own any of those call options? How do we know whether we should exercise them or not to collect the dividend, to collect that 60 cents? Because remember, again, if I just own a call option, I don't get that dividend. I have to turn it in and get stock in return. Otherwise, I don't get that dividend. How do we know whether that option should be exercised early? Okay, well, what happens to every option when they are exercised? It turns into stock with no extrinsic value, with no premium. So what you are doing is you are giving up. You are giving up. Okay. Now you don't want to just run the numbers, Paul. This is why you're here. You got to learn. Okay, we got to learn to read the markets rather than just letting our computer do it for us. Okay, so when we exercise an option call or put, what we're doing is giving up any premium, any extrinsic value that's left to turn it into stock. So basically zero extrinsic value. So what we have to look at is how much extrinsic value is left in the option that we are exercising. Or we can look at basically how much the put on that strike is trading for, because that is going to be extremely, extremely close to the amount of extrinsic value. So in the case of General Mills here, GIS, okay, if I have the 65 strike call, I'm not going to exercise that call, right? It's out of the money. I don't want to get stock at 65 just to collect a 60-cent dividend when the stock is 62.5. Likewise, the 62.5, which is pretty close. If I get stock at 62.5, okay, to collect the dividend, how much am I giving up? Well, I'm giving up the extrinsic value there of 65, 70 cents or so. So that one is, kind of really iffy, and I would not exercise that call. But if I look at the 60 call, there's almost no extrinsic value left, almost no premium left. So I'm really not giving anything up in order to get that 60-cent dividend. Excuse me. Does that make sense to everybody? That's how we look at it to measure whether a call should be in early exercise for a dividend. Let's look at another one here, AbbVie. AbbVie next week, so the dividend's not this week, but next week on the 15th pays a $1.64 dividend. Okay. Well, we're not going to exercise anything today or tomorrow or the next day. We would look at the 14th, which is next Tuesday. How would we know which call options we would exercise in order to get the dividend? Well, which of these puts have less premium than the dividend? That tells us that we would exercise to collect $1.64, giving up this amount of premium. If the dividend is going to be more than what we're giving up from the extrinsic value from the premium, we're more than likely going to exercise that call. Now, there are a couple instances where we might not, but that is the general rule of thumb. Okay, does that make sense to everybody? Because you have to remember, when an option is exercised, you're giving up any and all extrinsic value or premium that is left in that option. So what am I getting in return? Well, that dividend better be more than what I'm giving up in that extrinsic value. Okay, does that make sense, everyone? There we go. There is the Karen, and for anybody else, there is the link again to the video. Okay. Good. All right. The wheel, first wheel spin of the year. First wheel spin of the year. I love it. Before we spin that wheel, by the way, guys, can we please get everybody to smash that like button? Please, please, please. We got to start off 2025 with a bang. Box and camera guy, when the dividend is paid, doesn't the stock price go down? It does, but you're collecting that dividend. Smash it. That's right. Smash it. Your option trading, Dan, you're a little bit late. Today was 2025, so you're a little bit late for the wheel today. We will get you on tomorrow. What's up, Zora? All right. Because this is the first Market Minds of the year, also happens to be one of my son's birthdays today. Let's get 2 winners today. Let's get 2 winners. All right. Everybody's on a fresh slate. Let's get going here. Here's the first spin. First spin of the year goes to Ricky Fire. Ricky, thank you, Chris. Ricky, are you in the house?
Hey,
If you are in the house, please speak up. Ricky is here. Awesome, awesome, awesome. Okay. Mike, how do I chat in here? I see the chat, but how do I type in the chat here? Sorry, guys. Again, we're on this new platform today, which I think is coming through pretty good. Is it down here? No, I can't scroll any further. That's okay. Well, I'll have to figure that out later. If you could just type in there the Prosper Swag address, please. Okay, Ricky, you are now officially out of the wheel. And we're going to spin again here. Here we go. Here we go. Here we go. Number 2 wheel spin. Number 2 wheel spin goes to Gene or Nick. Gene. Nick O. That is a new winner for sure. No, Zora, it's very quiet down here today. Very, very quiet. Nick O, are you in the house? Nick O is here also. Wonderful. Okay, make sure you send an email, guys, to that email address, prosperswag@prospertrading.com. Gustavo, the wheel puts you in a contest like what we just did here. The wheel puts you in a contest to win some swag, win some Prosper swag. All right. Thank you. Thank you. Thank you, everybody. Appreciate it. Again, please smash the like button. Join us daily at noon. Be back tomorrow. You never know what that topic is going to be. Ashraf, every day you have to put whatever the word of the day is into the chat. Today's word of the day was actually a number, it's 2025. Thank you very much. I appreciate that. Thank you, everybody. Yeah, Gene, we missed everybody too, but even Market Minds had to take a week off. So, all right, everybody. Wish you all a great rest of your trading day, and we will see you all tomorrow. Have a good one, everybody.